and then into the area of the distribution, the area where a big, strong hands are going to start distributing the stock. And that's going to be in the extreme overbought condition, and where the sentiment is going to start shifting like it did in September, October of 2018 into the from the bullish bias or bullish sentiment into a bearish sentiment. And then as this distribution happens, that starts the markdown, a downtrend where on the way down, we're going to see different groups to capitulate at different points. And we'll talk about that as well in more details later on in the course. Now, each group is going to have specific emotional or psychological characteristics. And they behave in a specific way. Shahid, thank you so much for being here. And by the way, if anybody has to go, don't forget that, I'm going to post this video on YouTube so you could check it out later. So yeah, I really appreciate, especially for those of you who are in Europe right now or in the Middle East or in Asia. I understand your commitment and I appreciate this, and I see you. So thank you for that. So let's talk about that sentiment and the psychological landscape and the behaviors of strong and weak hands. Well, we know that in the downtrend, into the conclusion of the downtrend, into the stop in action, which will be defined as a sell-in climax, we're going to have extreme point of fear and capitulation by weak hands. Don't forget that weak hands are not necessarily just public. They are also institutional, professional hands. And therefore, that capitulation by that big amount of money that they carry, the equity that they have, is going to produce that quick move to the downside where they're saying, get me out at any price, I don't care, I'm done, I have too much of a pain, and my clients are on my back. So at that point of time, what this does, it creates, this type of action creates liquidity, and it also creates, with the price moving down, a value proposition to a composite operator. And we must say that it's not just liquidity, it's a high liquidity. And it's not just a value, but it's an extreme value on the long-term basis and a short-term basis. And that's exactly what people like Warren Buffett, Jim Rogers love. They want to come in and they want to take the stock at the best price and with the best availability, where everybody is given up in bunches and they're just saying, okay, I'll take it. I see the value here. And maybe not in 3 months, maybe not in 6 months, I will make money, but in a year, 2, as the price develops into a more favorable structure, and as the business conditions improve, whether it's market conditions, whether it's an industry group condition, and whether this is just the stock-related conditions, they're just basically saying that long-term, I see value. And I see that this is an extreme point. I'm going to come in and I'm going to buy. I'm going to establish that initial position or a chunk of my position. This is going to be the place where we will identify on the chart the first signs of intelligent accumulation by strong hands. And then throughout the whole trading range, a lot of people are still going to be disbelievers of the next bias that's going to come. So therefore, as the composite operator is going to buy on average at the lower price of the trading range, and that would produce the rallies. That's going to subsequently retest the levels of the support, and where the composite man is going to start adding to the position every time it hits their buying point. The sentiment gradually is going to change. those bears that were actively and aggressively selling, they're going to see that their trades don't work, or they work but not that great as in the downtrend, and they're going to give up. Some of the weak hands are going to give up their latest additions maybe, or the positions that they have had and they've held even through the downtrend. And Composite Man is just going to scoop all of the latest offering, and that's going to absorb the supply to the point where technically the price will start making higher highs and higher lows. This is where the emergence of a trend is going to occur, and this is an extremely important concept. Emergence of the trend is everything that I talk to institutional money managers. All of their systems are just basically based either on the contrarian value proposition or the emergence of a substantial trend. And this is where what I call the institutional trend followers are going to come in. And they're going to start establishing their positions. That will push the price even further up. The public is still not actively participating at this point because they are scared. They just had the pain of a loss that they incurred throughout the whole trading range. So as the price continues to the upside, this is where they are starting to become very active. It's in the second part of an uptrend of the markup phase. And because they are getting excited here, and they are producing more volume, and they are sustaining the selling by institutions that are selling now into the strength of the weak hands. Once that strength is exhausted, the selling is going to start producing the price structure that's going to resemble more of a consolidation. And when all of the buyers are going to be exhausted by this process, the price will start to deteriorate and it's going to start showing lower lows. By that time, the smart money, the real smart money in that particular position, and by the way, smart money as I see it now with all of this knowledge and experience that I have teaching and trading and working with people, whether institutional, retail people, the smart money definition is only relevant to the last trade that you make. So in a way, it's kind of like as like in NBA, a make or miss league, right? So you always have to be at that performance level where you're not just producing the positive result, but you are actually outperforming the index. Otherwise, why would they give you the money to manage? They could just give it to the market, put it in the ETFs, and just be done with that. So the definition for each of the institutions always changes with a specific trade. And they could be in one trade representing smart money, and in another trade they could be representing, weak hands. And Buffett is a good example. I mean, like, look at his, for instance, the trade in IBM where he came in and then he had to close out with the loss, and relatively soon as he opened the position. So even here, could be weak hands at some point of time. So weak hands at this point of time are seeing this as a value for the first time. They saw the value on the way up and they were correct here. They were enjoying the profits. They saw the value at the points of the lows at the support level in the consolidation, thinking that there's going to be a continuation. And then they're still seeing the value even as the price starts to deteriorate. And this is where everything collapses, because strong hands are out of the position. Completely, the Composite Man is out of the position, or it's just hedged in a way that still produces some kind of bearish sentiment. And then the weak hands are just capitulating in the markdown phase, and that's what produces a quick move to the downside, no buying and selling, and not just selling, not an orderly selling, but a capitulation. That's why bear markets are so quick, so aggressive, and so volatile. All right, let's go to the next slide. And guys, I'm gonna speed up at this point again. So I'm gonna come back to your comments, maybe a little bit later on. So here is an example of the price cycle with an Apple stock. This is a weekly chart. This is actually not the beginning of the cycle. This is just a reaccumulation of a much larger cycle that has started in 2009 low. And we're seeing the last reaccumulation before the distribution actually occurs. And we're seeing how after the consolidation with the bias to the upside, we have a really good markup phase, distribution after that, which leads us to the new low in 2013, accumulation again, and then the next move to the upside, and distribution again, consolidation in 2016, and you all know what has happened here and what has happened just lately. And you kind of could see that this goes on and on and on, and obviously price cycle could look slightly different on a secular basis for different stocks. But for this particular stock, you could take this cycle even from the point of the IPO, from the 1987 to 2003 trading range, which was a huge period, to be in that type of range with one huge big rally in the middle. But after that, it's all like that. This is just has been a pattern for Apple. So our goal is to understand what is happening in those consolidations, because it seems that it's out of those consolidations that we have the moves that we want to participate in. And those are directional trades. Obviously, you could use, some hedge trades even in the uptrends and downtrends as well. This is totally acceptable if you understand how to do this. But the course is just concentrating on the directional bias, on identification of that bias, on the timing of when the price is going to exhibit that bias or start exhibiting, on the emergence of the trend, and then obviously on the character of the move itself. And not only that, during the whole markup, markdown phase, especially markup, we are going to have a lot of spots, a lot of consolidations where we're going to apply our Wyckoff analysis, whether it's a phase analysis or price and volume analysis, and we're going to identify specific places of timing where we want to establish a position for the next potential swing to the upside. And hopefully you guys have seen this type of trading, from the case studies that I presented on my trades. By the way, on the YouTube channel, I have also published, quite a few trades, and all of my students here, you guys know that I usually discuss my trades. Again, this is something that I don't shy away. I think that, there should be more of that. It doesn't matter whether it's a mistake or a profitable trade. What matters is knowledge. Can we extract the knowledge from any of the trades? All right. So let's look now at the first reaccumulation box, and let's look at the selection process that we would go through. Oh, another slide. I'm sorry. Okay, so before we do that, couple of things on this slide. This is a very old slide. This is the slide that I created almost 10 years ago. And this slide was based on Hank Pruden, and I don't know whether it was Hank who kind of originated this idea. I think it was actually originally the idea from the Stock Market Institute. It's an idea of an action and test. The only thing here that I added here is the reaction. Right? So we have kind of like three things that are unfolding. action to the downside, reaction to that as a stop in action and a consolidation. And then the test of this reaction. Is this test going to fail and the price is going to go lower? Or is it going to stop, reverse, and the new trend is going to emerge? And we obviously could go even into a downtrend, into the consolidation and use the same thing. We could say that selling Climax by itself is an action that is being followed by the reaction of the automatic rally, and then being followed by the test of the secondary test in phase A. Or we could say that, as I told you before, the downtrend is an action, and then phase A and phase B is a reaction to that action, and phase C is a test to that reaction to that action. And the main thing that we want to identify within this process is a test in action, because the test in action usually is going to be identified by us as not just the testing tool, but also as a timing tool as well. If the test is successful, then most likely there's going to be a continuation of the buys that we think is developing during the consolidation. So therefore, the timing is going to be identified by us as a potential phase C. So each time we identify phase C, we're going to assume that this is the beginning of the next major move. And that's why phase C is so crucial. Well, if phase C is the low of the trend or the high of the trend, kind of like an extreme point of the trend, the beginning of the trend. And by the way, for those of you who are thinking, well, what about if phase B has, a low, then phase C, or a high, then phase C? You could be right in terms of the actual definition of the trend, but still we would prefer to be more efficient with our point of entry. We don't necessarily want to enter in phase B into the position. We want to enter into the position when the price is ready to move in the direction of the bias. So phase C is extremely important, and so is phase D. Why is phase D important? Well, because phase D is all about emergence of the trend. And phase D is all about a change of character that is being confirmed. From a non-trending environment, we are switching to a trending environment with a specific bias. Talking about Hank, I mentioned him. Obviously, Hank has passed suddenly. His last presentation was in August of 2017. Even talking about him right now, I kind of feel still so sad. He was a great man. He was definitely my first mentor here in the US, and I owe him my career, basically. And not just from the perspective of the Wyckoff method, which I consider him kind of like he was a guardian. He was always, he would always criticize me for bringing innovation into the method, bringing something like, those Romanisms, students call those Romanisms, like new definitions, new ideas, and so on and so forth. He was kind of like protecting the methodology in a very interesting way. And he not only, initially, and together with Bruce, they taught that class, but I think the first class I actually took from Hank by himself. Not only did he taught me the methodology, but he also taught me a lot of the business, and in a way, the community that we have built with Wyckoff Analytics, it has Hank's presence. It's a lot of the things that I've implemented and our team implemented is just based on Hank's work at Golden Gate University, and I'm just so happy and I feel privileged that I worked so closely with him in the last 6-7 years. And I've been in his classes. I always was advising students take his class, at least one. He was a very unique teacher, and a lot of the teaching techniques also I'm taken from him. Just a very extraordinary person and an extremely significant figure in my life, in my not just professional life, but partially also in the personal life. And just his whole family, it just was so nice, and it's still nice to me, and just I'm so sad that he's gone. But he lives through us, and this is the biggest thing that we could do for him and his family, is just to remember him, and remember him in the way how he was teaching us, to conduct ourselves in the market. His book, which is called The 3 Skills of Top Trading, is a required book for our students, and I definitely recommend this book to all of you to read. Chapters 3 to 7 specifically talk about the Wyckoff method, and those are the required chapters that I usually ask students to read. In this picture, this award he's holding is the award of the Chartered Market Technician that he received, I think, in April, and he passed away in August. So just months before he passed away. And not only he had received it from the Chartered Market Technician, which is the biggest technical analysis organization here in the US and around the world, but also from IFTA, International Federation of Technical Analysts, at the 2013 conference in San Francisco. And he definitely deserved it so much for the times when the methodology was not in a good shape. For like 20-30 years, it was not necessarily very profoundly highlighted as a technical analysis skill. Hank and Tom Williams, David Wise, Craig Schroeder, those are the 4 big figures at that time. And then new generation of Wyckoffers came, like Bruce, and we had quite a few Wyckoffers came out of those classes, like Jim Forte, and so on and so forth. And then, my generation came, and we became also, more knowledgeable about methodology just because of him. So just a lot of kudos to him, and the way how he conducted his life, and the way how he was with students, and just, still so many stories about that. Ditto, Eric. Yeah, I miss him too. All right, let's talk about the case study. So this example, we're looking at the trading range before the big move up. Actually, this is the range, and it's a complex range because you have a trading range structure on the trading range structure. Actually, I was in this trade to the downside. Apple was underperforming around this area. This was the trade and closed out somewhere here. So what does this trade tell us? That there is no ability to go down. The supply is not increasing over different other areas, and that suggests a reversal, a change of bias, and change of leadership, which we see on the sign of strength rally. We're definitely exhibiting more over leadership over the market. Looking at the relative strength ratio line, and this is something that we will explore. I will show you how to construct it. I will show you how to use it. I will show you how to interpret it. But here we're seeing that the relative strength is showing outperformance by Apple on this rally to the upside. And if you guys remember the market at the time, the market only has come to the high of the resistance and then went into the shakeout. And even on the shakeout, we see outperformance by Apple, where the market is creating a low and the stock is creating a high low. So strength, strength, which is great. And this would be, based on the comparative analysis, for us a point of selection. Now, there is one minus to what is going on here, and that is that supply is suddenly up. And we know when supply is going up, we always need a retest. And we have multiple retests which start to create a trading range. And therefore, when we go into the trading range, again, the things that we need to define is bias, timing, and character. And this is not necessarily the sequence with which Wyckoff was approaching this, or SMI was approaching this, or how I was taught at Golden Gate University. This is just what we've created for the WTC course. And this is how I teach the material right now. Those are the three elements that are extremely crucial to me to understand. I want to understand where the price is going to go, when it's going to go, and how it's going to go up. So as we go through the analysis of the consolidation, we are going through the phase analysis. And we are also going through the supply and demand analysis together with how the price reacts to that supply and demand. And we're seeing that supply is diminishing significantly into the area that looks to us as a potential phase C. So that defines not only the absorption of the supply, which gives us a bias to the upside, but it also gives us a timing. The time is now. Supply is very low. It's in strong hands. We could talk about also a short-term underperformance, which usually leads to great buying opportunities within the structure of the whole price cycle. And this is something that we will concentrate on as well. And then obviously the whole campaign, and then the next biggest Wyckoff identification for us would be a change of character. I actually I did not trade this particular rally in Apple, but I had multiple students back at Golden Gate and in my private practice that were trading Apple at the time. I wonder if you could guess where they exited their position. Well, before you even answer this, I'm going to tell you exactly where. Here, here, and here. And why do you think this is? What would be the logic of getting out of this position? I mean, obviously, except for the logic of smaller swing trade, which it wasn't. It was more of a big swing trade like this one or like this one, from one trading range to another, from one structure to another. Well, their logic was that supply is coming here. And my argument with them at the time was that look at the result of this supply coming in. And that's a very, very common mistake that students make. And that's why we're going to study a lot the result and effort. This is one of the most important concepts. If I would be picking the concept to teach, whether the concept of the supply overcoming the demand and the price going down, or a demand overcoming the supply and going up, in comparison to the effort and the result, I would choose effort and the result. Supply and demand is a very simplistic concept, but effort and the result requires an understanding and a visual skill of recognition. And that's exactly what's happening here. And that's exactly the mistake that we were trying to correct at that time. The key to the exit was a different behavior than we've exhibited on the way up. Look at all of the reactions on the way up. They are very small. And even though some of the volume signature increases in there is absorption on the way up. As supply occurs, it's being absorbed and the price moves up. But not on this reaction, not on the automatic reaction, which acts as a change of character. We see that not only supply is emerging in a lot, but it's also very consistent. And this is another definition that we've added to the Wyckoff trading course. Usually volume is being interpreted as just increase and the decrease, but we could see the consistency of selling in this area, as we have seen the consistency of selling here and here, attempt to sell. And what does this suggest? In all of these cases, it suggests a change of environment. So from the uptrend environment, we are going into a non-trending environment or a trending range. And at least minimally at this point, you should start thinking in your head, what should I do? Should I close out the positions? Should I scale out? If I'm anticipating a trading range, is this a very long-term trend, campaign trade for me? Then I should probably check out my PNF targets from back then in 2009, 2010, compare them with the PNF targets that we've just recently had, in the trading ranges. We would be making a decision here, but that decision would be based initially on the way how the price behaves on this reaction. And this is the skill and the knowledge that I'm going to give you guys. All right, 5:30. Let me see. Okay. All right, let me see what we're going to... Let's stop here. So what we are going to do is... obviously, we haven't gone through the whole material that I was planning for today, but this is great because what I'm going to ask you guys, for those of you who already signed up, is I'm going to ask you to read, and I'm going to ask you to watch the videos, and I'm going to ask you to prepare for the second class. And then we will go into the change of character, accumulation, and the distribution. I actually like that a lot. There is a question, have the seminar been recorded, from George? Yes. I'm recording it right now, and I'm going to post it on our YouTube channel, Wyckoff Trading Method. So you could probably check it out tomorrow morning or even late tonight. My team, will upload it and, put the description in. So check it out. Again, for those of you who are thinking about signing up for this course, let me just go to the correct page. So make sure that you go to wyckoffanalytics.com, that you find Wyckoff Trading course, and just sign up before next Monday, which is January 14th, to get the discounted price. If you have any questions, don't hesitate to reach us at wyckoffAssociates@gmail.com. You could find our contact information on our website, and just address it either to me or to our team, and we'll be more than happy to answer. I'm available tonight and tomorrow and throughout the week. So if you have any questions, maybe on the administrative side, or maybe content questions, don't hesitate to contact us. Meanwhile, students who signed up, I will email you tomorrow, and I will assign you the homework, which will be just reading specific chapters of Hank's book, Bruce's blogs, and watching our videos on YouTube. And that will be your homework. And then after the first class, once we cover change of character, accumulation, and distribution traits, then we will go into the homework, and you'll do the actual homework. Well, really great class, really great beginning. I feel like there is a lot of interaction from you guys. So hopefully that's going to just transition into the class itself. Let me just see kind of like last comments here from Doug. Oh, I love this comment. My brain hurts. Great detail session. Thank you. Thank you, Doug. And I know that you've taken classes from us, so you've been a student, so that's how it is. Thank you very much. Great information to consider. I trade commodities, was very interested in the program. So let me kind of like address this. And I think that there was another question here on Forex. So I've actually traded Forex for almost 5 years. It just was a little bit tough to intraday trade something like this, living on the West Coast in the US. Just so hectic during the night, to stay up. So I kind of gave it up. But Forex has the same price structure as other price structures. There are some nuances, obviously, volatility, interventions, and then also there is just always the reference to the bad volume data. So my answer to Forex traders is that take the course. Why? Well, because the price structural analysis is still a must. You have to understand the context of where you operate, where you trade. So that's number one. Secondly, some of the Forex traders use volume signature, so you can do that. Thirdly, relative and comparative analysis is still relevant in Forex markets. And one of my strategies was always buying the strongest of the correlated pairs and selling the weakest of the correlated pairs. And you could create pair trading like this or spread trading. You could just choose directionally which instrument you want to pick. So there are quite a few things there on the analytical level that you could use. And then you could also use a lot of tactics. And tactical decisions is something that you have to develop as a trader one way or another. So whenever I talk to Forex traders, I always tell them that this could be a foundational course for you. This could be the course where that kind of like defines the foundation on which you build further up. So consider that. And the same for the commodities traders. I actually love trading commodities. I love trading E-minis. I've day traded E-minis for quite some time. Occasionally I would make those trades here and there now. I predominantly trade stocks right now and specifically options, but I love trading oil. I trade gold. I trade metals sometimes whenever opportunity presents itself. So to me, trading is not about a specific instrument. Trading to me is about specific opportunity. And I think when you are becoming more and more advanced trader, you will understand that opportunities are very rare. Good opportunities are very rare. And our goal is to recognize them. And even when you recognize opportunities in the market, sometimes you fail, to see them or act on them. And sometimes opportunities come from very interesting places. Sometimes you would be thinking, oh, I trade stocks so that, I'm not going to trade other markets. Well, if you're a speculator and if you're an advanced trader, then you should consider that. Sometimes you look at different time frames and you see how, let's say, a long-term campaign would be much more profitable than, let's say, swing trading or intraday trading. And you should recognize that as an advanced trader. So this is something that, we talked more in the practicum, with more advanced students. And this is something that, I have to bring you to that level. Okay, great. Next comments and some questions here. Ramon, would be great if you set a number to the slides to have the reference to our notes. Eric, yes, for sure. If you are a student in this class, I can definitely do that for you. I'm not going to distribute the slides for people who are just guests. This is just kind of like a rule for this session. The biggest value is obviously I'm trying to give to the students who already signed up. But once in the class, remind me and I'll do that. What are the tools that are necessary to do the homework? This is a great question from Justin. So one of the things that I want you guys to do is obviously, and I mentioned this, bring me one file, email me one file that is going to be either PowerPoint, PDF, or Word doc. That's number one, requirement number one. Name it correctly so that I would know that it comes from you and that this is the homework number one or whatever. And then thirdly, as you use these tools, you probably have to understand how to capture the screen. Let's say if you're on stock charts, capture the screen, cut and paste into the PowerPoint, and then annotate those. So that's the process. And we could talk more about it if you still have some questions, during the next class. So I'll explain more how to do this, and actually, maybe I'll have a slide on some, usual practices. All right. Next question or comment. This comes from Lynn. Although Wyckoff method could fit into any time frame, understanding your trading style is more of a swing trading. Would the course curriculum be suitable for position traders who mainly hold stock for a few months to a year or more? Absolutely. And actually, I kind of slightly disagree with the way, Lim, how you phrased the question, but I understand what you're saying here. A good swing trader should understand the long-term campaign. And therefore, I teach you in Wyckoff Trading course a long-term campaign and swing trades within that long-term campaign. So a long-term campaign is going to be something where we will establish a long-term trend first, and then we will seek for the short-term counter trends, which could be a trading range by itself or a reaction within the context of a much larger trend. And you have to understand long-term campaigns. So if you're a long-term campaigner and if you're holding your positions from few months to a year and more, you definitely will benefit from the course. Good question. From Igor, how do you determine the strong and weak currency? So I mentioned correlated currencies, let's say like British pound to the US dollar, and let's say euro to the US dollar. So there are times when they are highly correlated and when they are less correlated, right? So it's during the times when they are highly correlated, and you have to define it, and there are sites that would tell you this, and you could see it from the chart as well when correlation is very strong. It's when this correlation is strong, this is where you want to use this concept, and based on the comparative analysis, just to define which one is stronger, which one is weaker. And if you're making directional trades, just to take the trade in the direction of the buys and use that definition. You could also use this for spread trading or pair trading, buying one currency, selling another currency, however you would create that type of strategy, and then trying to define the spots where the spread is increasing, and it always goes up and down, and has, sometimes it has a trend of its own, especially when correlation goes away. So you could create trades out of that as well. So hopefully that explains it. Okay, Craig is saying that my microphone is not working really well and that my voice is breaking up. Is that true for everyone, guys? How's my audio, by the way? I just want to know. This could be just either on your end or my voice could be just going down. And sometimes connection is not that great. So sometimes too much traffic. Yeah, okay, well, let me see what kind of audio we're going to have on this recording. I apologize if not everything was very clear, and Craig, thank you for noticing this. All right, last question, and then we're going to stop. Roman, what's the difference between Wyckoff Trading Course and Wyckoff Practicum? All right, so the Wyckoff Trading Course, think of this as a knowledge, and Wyckoff Practicum is something that a student with the knowledge does not have. That is a skill of recognition of those concepts that you know now. So I always tell my students, knowledge is not necessarily the skill of visual recognition. If you acquire the skill of visual recognition, you will see how the structure, the bias, the timing, the character unfolds. Now, my next statement is going to be that even if you acquired a skill of visual recognition, it doesn't mean that you can execute it. So you have to build a skill of execution. Those are tactics. Even if you conquered that, you still have to conquer the emotional part of trading, and that means that you will have to look deeply into your behaviors, trading behaviors, translate those into your life behaviors, compare those, and figure out how you fit into your trading style and into your methodology and so on and so forth. And this is definitely a very, very advanced level. Whenever I have a beginner or intermediate trader come to me and they say, I want to work on my mental outlook, I say no. You have to study first the methodology. You have to be comfortable with the technical analysis and recognition of those patterns so much that it doesn't distract your brain from concentrating on your mental landscape adjustments. And this is definitely a topic for another long conversation. All right, guys, I think that's it for today. Great session. Thank you for all of your comments, for all of your questions. This has been a blast. A great first session for those of you who signed up or are thinking about signing up. I'm looking forward to working with you. As you could see, a lot of material we have to cover in these 15 sessions. So we're going to start working more next class. Make sure that you have a headset and a speaker as we're going to interact, and I'm looking forward to it. Thank you, guys. Have a wonderful evening. Bye-bye.